What if I told you there's a completely legal way to pull money out of your business tax-free? Not as a salary where you pay payroll taxes, not as distributions where you might trigger other issues, just straight up IRS-approved, tax-free money in your pocket. And most business owners have no idea this exists. And what I'm talking about is accountable plans. And if you're an S-Corp owner working from home, this one strategy could easily put $4,000 or $5,000 back in your pocket every single year, not even lots more. So let's dive in. But here's the thing. If you're a business owner, you're constantly spending your own money on business expenses. We all know it. It just happens, right? Your home internet, that dedicated office space upstairs, gas driving to client meetings, maybe you grabbed lunch with a potential client, you threw it on your personal credit card. Most business owners just see these costs. They figure, well, I own the business anyways. What's the difference? Well, the difference is thousands of dollars in unnecessary taxes. See, without proper accountable plan, when you reimburse yourself for these expenses, the IRS can treat that reimbursement as taxable income to you, which means you're paying income tax and potentially payroll taxes on money you already spent. That's like paying taxes on paying yourself back. It's insane, right? So now I've been helping business owners optimize their tax situation for years, and accountable plans are one of those strategies that the IRS explicitly allows. It's right there in the Treasury Regulation, 1.62-2 in the IRS publication 463. But most people either don't know about them or set them up wrong. And here's the wild part. So with one big, beautiful bill act that passed in July 2025, this became even more important. That law permanently eliminated the ability for W-2 employees to deduct unreimbursed business expenses on their personal return. So that means if you don't have an accountable plan and you're an employee of your own S-Corp, you're just leaving money on the table. Okay, so what actually is an accountable plan? Think of it as a formal reimbursement policy for your business uses to pay you back for legitimate business expenses. So when set up correctly, you get three massive benefits. One, you receive the reimbursement completely tax-free, no income tax, no payroll taxes, nothing. Two, your business gets to deduct the full amount as a business expense, so it reduces your company's taxable income. And three, you don't have to report this money anywhere on your personal tax return. It's basically the holy grail of moving money from your business to your personal bank account. Now, the IRS isn't just handing this out for free. According to Treasury regulations, your plan has to meet three specific requirements. And this is where most people screwed up. Requirement one is business connection. The expenses you're reimbursing must be actual business expenses. You can't reimburse yourself for your kid's soccer lesson and call it a business expense. The IRS isn't stupid. So requirement number two is adequate substantiation. You need to prove these expenses with documentation, i.e. receipts, invoices, expense reports. It has to be within a reasonable time period. The IRS says 60 days is safe, but we'll get into the details of that in a minute. And then requirement three, return excess amounts. If you get reimbursed more than you actually spent, you have to get the excess amount back within a reasonable period, usually 120 days. No pocketing extra cash and calling it a reimbursement. Nail all three of these and you got yourself a legitimate accountable plan. So now let me tell you where this goes wrong. I once had a client, let's call him Dave, who thought he had an accountable plan. Dave would reimburse himself by just moving random amounts from his business account to his personal account whenever he felt like it. No receipts, no documentation, just vibes. The IRS did not appreciate Dave's vibes-based accounting system. When they audited him, they reclassified every single reimbursement as taxable wages. Dave ended up owing back payroll taxes, penalties, interest on about $30,000 worth of reimbursements. Don't be like Dave. Documentation matters. The IRS is very specific about this stuff for a reason. They want to make sure you're not just using accountable plans as a way to dodge payroll taxes. All right, let's break down each of these three requirements so you can actually implement this correctly. So rule number one, business connection. Your expenses have to be connected to your business. This seems obvious, but here's what qualifies. Home office expenses. If you have a dedicated space used exclusively and regularly for business, according to the Internal Revenue Code, the space must be your principal place of business or where you meet with clients. Business mileage. So you can driving to client meetings, bank for business, supply runs. The 2025 IRS mileage rate is 70 cents per mile for business use. Mixed use expenses, things like your cell phone or internet that you use for both business and personal, you can reimburse those things based on the business use percentage. Travel, meals, supplies, anything ordinary necessary again for your business, you can deduct. Rule number two, adequate substantiation. This is where you really need to be really diligent. The IRS requires you to document your expenses properly. So what does adequate mean? So according to the IRS publication 463, you need the amount of the expense, the date it was incurred, the place or description of the expense, and the business purpose. So those are the things that need to be identified. For most expenses, that means keeping receipts. So for meals, you need to know who you met with and what you discussed. For mileage, you need a mileage log. Here's the timeline. You need to submit your expense report to your company within a reasonable period. The IRS safe harbor is 60 days from when you incur the expense. Don't wait until December to submit expenses from January. That's asking for trouble. So rule number three, return excess amounts. If your company gives you an advance, say $1,000 for a business trip, and you only spend $850, you have to return the extra $150. The IRS safe harbor for returning excess amounts is 120 days. If you don't return it, guess what? It becomes taxable income. So this is why most accountants recommend doing reimbursements after the expense, not before. Cleaner, and there's no excess to worry about. Okay, so how do you actually set this up? So step one, you create a written policy. Now, technically, the IRS doesn't require a written plan, but trust me, you want this in writing just to be safe. If you ever get audited, having a documented policy shows you are operating in good faith. Your written policy should include what expenses are reimbursed, documentation required, the timeline for submitting expenses, the process for getting reimbursed, and what happens with excess reimbursements. You don't need some fancy legal document. A simple one-page policy works fine. Many CPAs have templates for this. Step two, create an expense report template. This is your monthly or quarterly documentation. It should include date of expense, description of the expense, business purpose, amount, and receipts attached. So if you have something like QuickBooks, you can actually upload your receipts right into QuickBooks or use a Google Drive folder or something like that just to keep this all organized. I recommend doing this monthly. Even if just for yourself, it creates a paper trail and shows consistent compliance. Step three, calculate your reimbursements correctly. So here's where the math comes in, especially for home office expenses. So let's say your home is 2,000 square feet and your dedicated office space is 200 square feet. That's 10% of your home. If your monthly mortgage or rent is $2,000, you can be reimbursed $200 per month, aka 10% of $2,000. Same calculation applies to property taxes, homeowners insurance, utilities, internet, and maintenance and repairs. One critical thing, you have to reduce your itemized deductions on your personal return by the amount your S-Corp reimburses for your mortgage interest and your property taxes. If your S-Corp reimburses you $2,000 for your mortgage interest, you can only deduct the remaining mortgage interest on your Schedule A. So step four, process reimbursements separately. Don't mix reimbursements with payroll or profit distributions. Keep them completely separate in your bookkeeping. Why? Because the IRS looks at your books and sees reimbursements mixed in with regular payroll, question whether it's a reimbursement or just disguised wages. Step five, again, keep immaculate records. Cannot stress this enough. Documentation is everything. Keep all receipts for at least 3 years. Keep copies of all expense reports. Keep proof of reimbursement payments. If you can't substantiate an expense, it's not reimbursable under an accountable plan. End of story. So let me show you what this looks like with real numbers. Let's say you're an S-Corp owner with 300 square foot home, or home office in a 2,000 square foot house. That's 15% business use. Your monthly home expenses, mortgage, $2,500, property tax, $500, insurance $150, utilities $300, internet $100. So your total is $3,550 per month. So 15% of $3,550 equals $533 per month. So $533 times 12 months equals $6,396 per year. So your S-Corp can reimburse you $6,396 per year, again, completely tax-free. Now let's say you're in the 24% federal tax bracket and your state has a 5% income tax without an accountable plan. If you took that money as additional salary, here's what you'd pay. Federal income tax at 24%, that's $1,535. State income tax at 5%, $320. Social Security Medicare at 7.56% and 5%, $489. Total taxes, $2,344. By using an accountable plan instead, you keep that entire $2,344 in your pocket. Add in business mileage, maybe a couple client meals, and if you're easily looking at $3,000 to $5,000 in annual tax savings just by doing this correctly. And depending on your business, could be even substantially more. So let me give you a few pro tips that most people miss. So tip number one, you can't use the simplified method. So the IRS allows sole proprietors to use a simplified home office deduction, which is $5 per square foot up to 300 square feet. Easy math, right? Here's the thing, that the simplified method is not available for accountable plan reimbursements. You have to use actual expenses, no shortcuts. Tip number two, monthly reimbursements are better than annual. Don't wait until the end of the year to reimburse yourself. Process monthly or quarterly expense reports. It shows consistent compliance, and if the IRS ever audits you, it looks way more legitimate than one giant year-end reimbursement. Tip number three, be careful with percentage calculations. The IRS gets suspicious when your home office is more than 30% of your total square footage. It's not automatically disallowed because there are, people that run businesses out of, a small apartment in San Francisco, right? Single unit or one bedroom apartment. So, that's an exception, right? But the extra percentage might trigger extra scrutiny. So make sure you can justify that space is truly used used exclusively for business. So tip number 4, don't forget the 50-mile rule. If you have a home office as your principal place of business, your commute from home to other work locations becomes deductible as business mileage. This can add hundreds of dollars in additional reimbursements, but again, it has to be from your home office to other office locations. So these are some common mistakes to avoid. 1, reimbursing through your personal bank account. It must go through the business. Not having documentation ready when you process your reimbursements. Mixing personal and business expenses on the same receipt. Failing to update your plan when your business use percentage changes. Look, accountable plans are one of those strategies that sounds complicated, but really isn't once you understand the rules. The IRS literally created this framework to let you do exactly what we've discussed today. But here's my advice. Don't try to wing this on your own. Work with a CPA or tax professional to set up your plan correctly the first time. The cost of getting professional help, maybe a few $100, is nothing compared to what you'll save every single year, and it's way less than what you'll pay in penalties if you get it wrong. So if you found this valuable, make sure you subscribe to the channel because I break down strategies like this all the time, practical tax planning that actually puts money back in your pocket. And hey, if you're an S-Corp owner and you're not using an accountable plan right now, you're literally paying extra taxes you don't have to pay. Fix that this year. There's still plenty of time. Thanks for watching. Drop a comment if you have any questions about accountable plans or if you want me to cover other business tax strategies. Until next time, keep more of what you earn. Cheers.